Hey everybody, this is Paul doing a video here on Thursday the 29th, about one day before the end of the month here. So I figure this is a good time to do a video. I was going to do a video yesterday, but I kept getting phone calls and the market was up and it was just kind of, I don't know. I was basically going to advise people not to really buy anything because that market was definitely pulling a fake out. It should have been kind of obvious if you were looking around. Um, as to like what was kind of causing some problems there. So let's kind of look around and see what we got here. So as it stands right now, market's definitely pulling back from what it had yesterday. Um, so I guess I could try to explain what yesterday was. And this market isn't exactly as complicated as it used to be. We're still waiting on earnings, obviously. Um, but what's swinging this market around so much is currencies and bonds. So I did one video where I talked about currency, and I said it's literally called "Let's Talk About Currencies," where I kind of warned. So I'm not, I'm not a fixed income or currency trader or FX trader as they call them. I just kind of observe what people way smarter than me say. Now I didn't understand how that because I wasn't around and like I wasn't trading in like the 90s when EM crisis and or the 80s when just these different crises happen with currency in emerging markets because of the strong dollar. So I didn't know exactly how it fed through into the market, but I guess we're getting a good lesson right now as to how all that feeds in through the market. Um, so why was the market up yesterday? Okay, the Bank of England pivoted. It's kind of what they did. They said we're going to have a recession next year. We're expecting a recession next year. So I was on Twitter basically saying, if you're saying you're going to have a recession, then raise your rates. Your government's talking about doing stimulus, which is in the form of tax cuts. It's a form of stimulus, while your inflation's at 9 point something percent, and the Federal Reserve is raising rates. And everybody was basically on Twitter saying, well, then raise your rates. I thought they would do 100 basis points in an emergency meeting because they couldn't ignore their currency literally collapsing. This right here, Great British Pound, they couldn't ignore this because this got down to 107 and it was just falling further. So some people were calling for 200 basis points, which is pretty huge, right? And didn't happen. But they did have an emergency meeting because their pension funds almost blew up. So they had to go in and start buying bonds again at the exact same time that they're talking about raising rates. So they're doing QE. They still want to do QT, so go have fun with that, where they roll off bonds that they're buying or that they bought, but they also want to do raise rates, but they also want to do QE, where I don't even know what they're calling it, but it's QE. They're literally buying the 30 year because their pension funds nearly blew up. So there's that, right? And if those had gone, the pension funds almost got forced into forced liquidations, which is where they have to dump a bunch of things because I don't know who's running their pension funds over there, but they were in some ridiculously risky stuff. So our market saw that, and then also the UK has a problem with a lot of people are on floating rate mortgages, which is like adjustable rates, and that would have been bad. So they're really kind of forced to pull a Japan here, where they just kind of I don't know what the UK is going to do. They're in real trouble, but they've bailed themselves out for another month or a few months. I'm not even sure because Japan's been going, or I'm not even sure Japan's doing something, but their currency's weakening. So what they did is they saved their bond market by sacrificing their currency, but their currency's actually strengthening right now, which is kind of funny, which is really making people on Twitter angry. And then our currency's weakening. So what happened yesterday? Well, everybody saw that and said, if they did it, then the Federal Reserve is going to do it too. Even though we haven't had a pension fund come out and say we're going to force liquidations, we don't have a bunch of people with adjustable rates. And then also, if you go to Twitter here, I retweeted Liz Ann Saunders. Where is she at? Somewhere in here. and then I retweeted Liz Ann Saunders. So these numbers came in today. The initial claims right here are down again, but the Federal Reserve said they're trying to tank the market. So that's what the market is responding to right now, is the reality. There's just a reality check that has to happen in our market, that this right here, we were kind of set up for a relief rally because the market was very, very oversold by every single indicator that you look at. It's just, you can only go so far down before you need earnings to kind of justify these types of moves. So you need something like Apple to come out and say, yeah, we're kind of seeing slowdowns. And, you kind of need to see slowdowns in different places to justify these types of moves. If you want to go lower into like the 3,400, the 3,200 range for the SPY here, or like the 3,000, which is the Great Recession type stuff. If you want to go back to those, if you want to go to those levels in the market, you need those. If you want to go there, then you need earnings to effectively collapse. You need companies to come out and say, we completely missed our earnings because of this ridiculousness right here called the US dollar. As you can see, other currencies are just dying by the wayside. US dollar is just insanely strong. We're just not there yet. Bears have been very, very early. Bears have been wrong for the last 10 years because they fought the Fed. Now that the Fed is going their direction, they're doing kind of a victory lap, but we're just not to these levels that they want to see yet. Mike Wilson's been calling for 3,200 since the beginning of the year, and he keeps calling it too soon, even though earnings keep coming in stronger. Like Costco reported earnings, and they came out great. We're just not to the area where, like, you need earnings to kind of fall apart. And then also, as you can tell, the initial jobless claims is not falling apart. So the Fed, the market keeps hoping. It gets into like this weird mood where it keeps hoping for these reversals. Like, we're going to get this reversal. Look, we're very tight. But the Fed has made it very clear they want to get to 4.6 right here, and we're really, really close to this. Like, they want to get to 4.6 priced in and then hold it there for an entire year. We are not there yet. We haven't had anything blow up. We might. Chances are we have something big blow up, or somebody who owns a lot of housing that's getting completely marked down right now. But we just haven't had the big blow up. Like, the dollar hasn't blown up too much yet. It's killing it's just killing everything else. There's so much money flowing out of these countries trying to get US dollars right now. It's ridiculous. So that's kind of where we're at right now. I guess CarMax had something going on today. Yeah. Probably. Yeah. So this is literally, the market in theory should be rallying off of this type of news, but they're looking at the unemployment claims, and they see that as like an excuse for the Federal Reserve to go more. Also, you had the an inflation indicator come in stronger than you want. If you follow Liz Ann Saunders, if I go back to my main page here, Liz Ann Saunders had a thing this morning. I strongly, strongly recommend following her. She is very technical and gives you very good information. But this is the problem. Third revision for 2Q, even though 2Q is very, very lag data right now, this is very bad stuff to be using right now. But personal consumption component G revised from 1.5% to 2%. So that's going to make it harder for the Fed to hit their target of 2% inflation. That's a problem. That's a big problem. So you combine this news with the jobless claims news, and then you get into a very big problem. So what you want to see is kind of this. This is kind of, so that is a lagging information right here. You see this is lagging information. CarMax is also lagging, but they're also giving guidance on what they see. See that right there where they're talking about the used car industry? This is part of the report that made GDP go up last month. or not GDP, made CPI go up last month. The inflation report, the new car, the used car kind of stuff. This is what you want to see is basically these types of companies starting to have problems. You don't want them to collapse, obviously, because that's they'll just flood the market and cause a bunch of deflation. But what you kind of want to see is kind of something like this, where these types of companies, the ones that are supposed to get hit by these markets or these interest rates, where they start to tell you that they're seeing problems. So that's kind of where we're at right now. So what did I actually do yesterday? So I knew that the market was going to go down. I just we're just not there yet. The Fed's not talking about pivoting. I've already made the mistake of trying to like time a pivot, and you can see how that turned out for me with these two tech stocks that I never would normally touch. I got into, and then I also got into QYLD in a big way, and you see how that turned out. So I'm trying to make the best of a worse situation here, but as you can see, so basically what I did yesterday is I added Coke, just 2 shares of Coke, because it was the only stock that was down in my portfolio yesterday. And as you can see, it's still up 1.17%. So this was actually down yesterday. I said, what's the only thing that's down? Because I was up basically this amount right here yesterday. I was up this amount yesterday, and I looked at my portfolio and I said, what's the only thing that's up? Well, Coke's the only thing that's up. So that is how you have to treat these rallies that you have in this market until you see the Fed come out and say, yeah, we're comfortable where we're at. We're going to pause. This is the pause that everybody's looking for. When you get that pause, this market's going to rocket. And yesterday's kind of a good, it blows through whatever technical levels, like these little technical levels they have, it just shoots through them. Um, and then if you ever see them do a cut, that's going to be, that's when you're going to wish you had been pre-positioned for all this stuff, like whatever these losses are. That's when this market is going to wipe these losses off like it's nothing. Like they're going to smear these losses off and just throw them to the wayside. Like this kind of stuff right here, this kind of stuff right here, like this will go up by like 10% in like a week. If you ever hear them talk about pivot, cut, that kind of stuff. But we're just not there yet. We just don't have the U.S. data to say, okay, they have to do this because this fund's about to collapse. We just don't have that type of stuff yet. Um, we're about to go into kind of an interesting period. We could get a bounce. That's kind of a thing. So we could get a bounce because earnings are about to start coming in for the big companies. Now, it could be temporary because they could guide and say, well, we don't know what's going to happen next year, so we're not giving guidance. You don't really get out of these bear markets until the Fed calms down and backs off, and until companies feel comfortable giving you guidance. When companies start giving you guidance, that's kind of when you start getting into a new bull market. That's when you can break through the previous highs, that kind of stuff. We're not even remotely there yet. Um, so yeah, we're definitely not there. So this is kind of, and then we have a bunch of like negative GDP reports. Third quarter is probably going to also be negative. As you can, like, this is just a mess. So this is still negative. This is still negative. 3Q is looking to be negative. I'm not even sure. It's still not even being called a recession, which is just really weird. But so you're going to end up with 3 quarters of negative GDP. They're probably going to end up saying in the long run that the recession started here, but you can't say it yet because we still have positive job growth. And it's a very interesting situation. So what do I add in these situations? So I wanted to go over that in this video. Um, in theory, my portfolio should be down much further, much further. Um, right now I'm at 46,000. As I stated in my last video, the only way I can really track this stuff is through the share count these days. I think my previous video I was at 2019 shares, and now I'm at 2161. So that's dividend reinvesting plus, you see this DoorDash money right here? That's where I track this at. So as you can see, I've made that much in DoorDash money since I started doing it at the end of June, and this is how much I have moved over to this account right here. As you can see, typically about 64 to 80, or depending on the time of the month, but As you can see, mostly 60% of the money's being invested. Now, this is going to get taxed at some point, but I'm not there yet. So right now, I'm just trying to pile as much in. So in theory, if this never existed, I should be down another 5,000 here. And then also I had that loan that I took out just to add even more money, which was that guy right there, to put in because I have obviously I have the income and the credit to handle that, so that was a very easy thing. Um, so as you can see, so where am I piling it into right now? Almost exclusively into the long term. You can kind of see I'm up to 21,821. It's kind of hard to see because it's it's going down obviously, but as you can kind of get a general idea, the long term, you have to look at the dividends. It's probably a better way to do it. As you can see, the dividends, I think my last video was this was like 829 probably. So where do I pile money into? AT&T, Intel, um, anything that I can, like 3M, KMB for sure, without a doubt, KMB for sure. Coke, Starbucks for they just raised their dividend, which is awesome. Caterpillar, if I can afford it, MO, just pretty much any of these 25 stocks right here, right now. And that's kind of where I'm piling money into. I'm just piling money in there. Um, these are just ridiculously cheap levels. Verizon is like one of three phone carriers in the United States. What's like, is T-Mobile gonna buy them? Like, it doesn't make any sense. Like AT&T is basically taking over like my part of Louisiana. Like they're literally taking over my part of Louisiana, like in cable and like different phone service and type stuff like that. They're just you can't they every single day you see an AT&T truck out here doing like investments in like infrastructure, and that really goes a long way with people. Um, it's gonna swing a lot. It sucks. We're probably gonna go down another 5 to 10%. I mean, it's because we're not going to get much earnings guidance. We're like the earnings might beat, but then all of us, the bears will be able to easily come back and say, well, they didn't give you guidance because they don't know what's going to happen. The reason why companies don't know what's going to happen is because of this, because of that, because they can't tell you where this is going to be, and also that. Like they can't tell you what's going to happen. Like they're going to guide lower just because they are kind of forced to. They're kind of literally forced to. Like even Apple's going to come out and say, "Well, we don't, we can't give you much clarity on what's going on. Like the globe kind of looks like a mess." But they don't know. Like if a pension fund blows up in the United States and the Federal Reserve has to come in, all of a sudden you're going to see this drop like a rock. You're going to see this drop like a rock. Like all of this is going to drop like a rock. The dollar's going to go down like in crater. Like there's just going to be different things that just drop like a rock. Like there's just USD JPY is going to completely just drop like a rock. There's just different things that are just going to fall so fast. And the UK should give you a general idea of just how quick that could reverse on you. This was basically financial crisis territory. It was getting there. This is where your currency literally affects your policy. Like you're literally forced to stop doing what you're doing and just kind of. But they bought themselves some time. So what am I adding to right now? Like basically anything in the long-term portfolio. That's anything that's down here right now. Um, Definitely anything that still has a line around the corner too. Like if you drive past a place and you see a big line, like these are kind of Starbucks is the most obvious example of that. If you drive past a Starbucks and you still see long lines, that's not the consumer falling apart. If you walk through, if you go to a Walgreens and you still see it's packed, you know, I'm still going to buy Walgreens. Like if you go to and buy Coke at Target and you see all the Cokes are sold out because of the football games, that's not a consumer that's collapsing, okay? um, J&J, if you just see these different products just completely sold out on a shelf, if you go to a Walmart and you see it's packed, you're not that's not the consumer falling apart. So these companies are going to make it to the other side of this. Intel is literally one of three companies that do like semiconductors. I mean, there's other ones that do, but like chips and that type of stuff. AMD and Intel are kind of running the game right now. it sucks. It's horrible where the price is. Like, I'm not a fan of where Intel's price is. But if they announce a new CEO or they announce a change in direction or become more competitive with AMD, this becomes much, much higher. Um, and it's paying a dividend while we're at it. Now, they might cut the dividend. I seriously doubt that. But, it's like one of two companies that provide like chips that are in your computer. It's AMD and them. Like, AMD slips up and starts charging too much for their chips, which they are doing, but they're putting out really good products, so people are kind of willing to pay for it. All of a sudden, Intel's back on top. Like, that's how these two kind of go at each other. So I have no problem adding to anything that you see on the screen. Um, so that's kind of where we're at right now. I wouldn't mind adding more into Caterpillar, definitely at these price levels. I think their 52-week high is like 220 or something like that. So, especially with the infrastructure bill, if you drop past any of this road construction that you probably see in your city right now, they're all driving Caterpillar stuff. That's why analysts really haven't like lowered their stuff. So I would not mind adding more to Caterpillar. Without a doubt, I would not mind adding more to Caterpillar. If anything, that would be like one of my ideal areas to add things. I wish E-Trade allowed partial share. If E-Trade allowed partial share buying, I would be adding a very large amount to Caterpillar. That's just a really good place to go. CHD, I also want to increase some of these positions, but that's kind of where the money's going right now. That's kind of where we're at. I can't really predict where the market's going to go. I can't. Um, it depends on earnings. Earnings is going to tell you where this is going to go. Earnings are going to tell you because the Fed is only going to go so far before they legit break stuff. They will break things if they try to go to five, that kind of stuff. Like the U.S. budget deficit alone is going to like kind of make them start second thinking this stuff. Um, and then also one thing I noticed is people are trying to figure out like why haven't companies gone bankrupt. It's because of COVID. COVID lowered rates down through the floor into negative rates, and a bunch of companies realized we need to get our balance sheets together, which they did. So they also all their debt is in like the 2% range kind of stuff. Companies were issuing debt out of this world during COVID because those rates were so low. So that's why you haven't seen a bunch of companies just completely rolling over now. A lot of that debt starts to mature next year. Now, if we're still sitting at 4.6 or 4.2 or whatever, 4.6 on a 2 year next year, then we have really big problems. But if we're through if rates have fallen by a lot by then, we should be fine. So that is kind of where we're at right now. So there's the market right now. It's kind of an ugly day, but I mean, we're literally basically back to levels. Actually, we're higher because 3623 is a level to retest. If we break through 3623, I think the next level is somewhere in 3500, and then below that 3400. Like we can get to some of these technical levels. Like this is all technical trading right now. These are all just computers trading with each other. So that's where we're at right now. I'll do a checkup obviously on the 15th. I think for me, this market is low enough where if I have money, I'm just going to invest it right away. Um, we're just to the point where it's just like the Fed is only going to go so much further unless inflation just doesn't go nowhere. It's so weird. I don't know what the Fed's doing. Nobody knows what the Fed's doing. I don't even think the Fed knows what the Fed is doing. They're just waiting for something to break so they have an excuse to ease again, I guess. But that's kind of where we're at right now. It's an ugly mess. I mean, down 20% does not feel good, but you go out to the 1 year, it gets a little better. You go out to the 2 year, I'm back to positive. You go out to the 3 year, still positive. So it's just one of those things where you just have like a year to date that's just you don't want to look at it on a screen. But this is when millionaires are made. They said if you have the money to buy, but the people trying to time the bottom are just I don't know. I can't do it. It's too stressful. I would be sitting on like a puck. If you were trying to time that bottom, probably by that point I'd be sitting on a cash pile of like 10 grand or something like that, and trying to hit that perfect little bottom and then like have a computer buy it before me. You're never going to time that perfectly. So that's where we're at. Leave any comments, of course, and then I'll be happy to answer anything. So y'all have a nice day. Thank you.